Let's bring in Gary Black, manager partner of the Future Fund, and I'm sure loving the big tech strength as much as anybody, of course, including and not limited to, though, Tesla's big run-up, because you're a big Tesla bull, Gary, and I know you haven't changed your thoughts about it at all, right?
Nope, we're still bullish here, even though it's up 110% year to date, but it had a bad 2012. But they're going to have good second quarter. The volumes will come out in a couple of weeks. They'll be up 75% year over year. The Cybertruck is coming probably in third quarter, which is a little early. And everybody's talking about it as an AI play. They've been investing a lot. They're going to start licensing their Dojo supercomputer probably next year. They're setting up a separate business unit, we believe. So that gives it a little bit even more spark. So we're still pretty bullish on it, even though it's up at about 52 times next year's earnings, but it's growing at 35%. So it doesn't look expensive the way we look at it, price earnings to growth. We think it's still a relatively cheap stock. We like it.
What do you think could be within the realm of possibility for Tesla's stock? Could we be seeing all-time highs again in this company?
We're still down from where we were. Back, remember in the fourth quarter, Elon had to sell about 23 billion of his Tesla stock to buy Twitter, and you had all this discounting going on in China and then in the U.S. Revisions to make the stock go to a new high, which we think is possible. You've got to get revisions to turn around, meaning earnings estimates have been dropping all year because they took pricing down in the first quarter, and they've stabilized, and that's why the stock has had an amazing run since about May 15th or so, because people believe that the second quarter gross margins are the trough, because we haven't seen any price cuts. Pricing has actually been stable. As we mentioned, people are getting excited about the Cybertruck. The last time they had a new product like this was in 2020 when they introduced Model Y, which was a crossover. And the stock, as you know, went up sevenfold in 2020 versus, I think, NASDAQ was up about 50%. So we think that's what you're going to get. Everybody's going to be very excited when Cybertruck deliveries start. It's very unique looking. I don't know if you've ever seen one up close, but it's about as big as an F-150. It looks like it belongs on Mars. But people are going to see it, and then they're going to go to the Tesla website or go to the Tesla store and buy a Model 3 or Model Y. That's what happened with Model Y. It just stimulated interest in the Tesla brand. And we haven't talked about all these EV charging arrangements between GM, Ford, now Rivian.
Yeah, everybody's on board.
The whole industry is getting behind the Tesla NACS standard. That's probably worth another 20 cents a share. We think the Cybertruck, because the street is underestimating it, is worth about 60 cents a share. So we think estimates for 2024, street estimates are about 70, 80 cents too low. And we think we'll start seeing people get more excited about Tesla as we get to the back half of the year and Cybertruck comes out. Now, that's interesting that Morgan Stanley downgraded today. It was a surprise to me that he took his price target up, but he downgraded stock. He took his earnings estimates up. So that's not usual. Usually when people take earnings estimates up and price targets up, they don't downgrade the stock, but maybe he was just getting tired of it. Who knows?
The company's been important to your fund, the FFND ETF, the Future Fund ETF, year to date, up 26%. Where is Tesla as a percent of that fund at this point? Gary, give us an update. And then also, do you, though, still have a fund that is dependent on a company, concentrated on a company here, that obviously last year got slammed?
Yeah. So Tesla is about 10% of the portfolio today. Okay. We took it down actually before first quarter earnings because we thought the estimates were too high because of the price cuts. The stock at the time, the stock was about 180, and then we bought back about half of it at 168. Not that we were day trading, but we thought the estimates had come down enough. And then the annual meeting happened. And we just felt very optimistic that Elon wasn't going anywhere. There was some debate that, maybe he would go to Twitter and give up Tesla. He hired Linda Yaccarino to run Twitter, which is great. I know Linda, I've talked to her many times. She will be great at Twitter. So we think there's less of a chance that he'll have to put money into Twitter because we think she can turn this around. You've got 2024 for Twitter. You've got the election. You've got the Olympics. So they should be cash flow positive by the end of the year, and she's a very strong media operator, so we feel good about that.
So you feel it's not going to distract Elon?
Correct, and he's not going to have to put money in, which is the most important thing. But more importantly, to your point, we think that earnings can start turning around here because the pricing has firmed up. Cybertruck's going to be huge. The charging, contracts that they've set with GM and Ford and Rivian, and probably Stellantis is next, and maybe Toyota will be very good for Tesla. And in the meantime, we still have, the IRA credit just went into effect this year with $7,500. Tesla's getting on its Model 3 and Model Y, which are 90% of its volume. So we think there's a lot of information out there that is still not being incorporated into Tesla stock. So we're keeping it at about a 10% weight. We do worry a little bit about, the economy.
Right.
I heard you talk about before that if the recession hits, because the Fed insists on continuing to raise rates, as Powell has talked about the last 2 days, a recession will hurt the auto industry and it'll hurt Tesla. So that's probably the biggest risk, that the Fed does something stupid and keeps raising rates here.
Okay, well, the last part there, of course, your own opinion inserted. Maybe fighting inflation is the smart thing long term, even if it means Tesla going down. Another two-parter for you real quick, Gary. Number one is, do you think there are price cuts in the 6-month to year-long future for Tesla's cars like it did earlier this year and late last year? And number two, is that a sign, if it happens, that things are softening on the margin?
I don't think we're going to have more price cuts on Model Y, which is where all the volume is. That's now become the best-selling car and truck in the United States, even not just EVs, all cars. And the inventories are very low. We track the inventories every day. We can see them. And the inventories around the world are pretty low. So we don't see that. What we are seeing for the second quarter, there's some inventory discounts on Model 3, Model S, and X, which, again, that's not the same as a price cut, because once the inventory is gone, or at least depleted, then the price cuts go away. So we are seeing some of that as we end second quarter. But I think that goes back to our investment thesis. Second quarter will be the trough in gross margins. Gross margins at Tesla, auto gross margins, were about 30% last year. They dropped to 19 after the price cuts in first quarter. This quarter, we think they'll get down to 17. And then we see a gradual increase back into the 21, 22, 23 range. We've already seen price increases on Model Y, since April, as the inventories have fallen. So I don't think we're going to see price cuts. Again, and the other thing that's really important is the EV credit goes from being a tax credit this year to an instant rebate next year. And so that means you could walk into a Tesla store, take $7,500 off, and when you're coming up with your loan payments, it's based on a $7,500 lower price versus a tax credit. You got to wait for your income tax return, and then you get the credit back. It's having an instant rebate off the purchase price is so much better, and that kicks into play January 1st of 2024. So there's really no need for a price cut, I guess, at this point in our mind.
Okay. Hey, real fast, you also launched a long-short fund.
Yeah. Thanks for asking.
Can you give us the kind of 60-second elevator pitch on how you're going to run it?
So FFLS, it's very unique. There aren't many fundamental-driven, bottom-up, long-short ETFs out there. It's high conviction. We have 30 longs, 20 shorts, and we play off the same mega trends that we use on the long side, same research, where we're looking at 24/7 information, entertainment, climate sustainability, big data, people living longer, lifestyle betterment. So when you see a short, it'll usually be something that's getting hurt by those mega trends. So a good example is Toyota. It's our largest short. Tesla's our second largest long. Google's our number one long. But Toyota's got 10% of the market globally, and they are nowhere in EVs. So as EV adoption continues to rocket ahead, it's 10% last year, it'll be 15 this year globally. We think it'll be 60% by 2030. They're nowhere in EVs. So it's our largest short. And so we're trying to look for offsetting hedges, because back to the market, we think the rest of the year is going to be pretty choppy. The Fed isn't sure. Well, we don't think the Fed, even though they sound sure, but we don't think they're sure they're going to actually raise rates the rest of the year. And so as we go through this choppy period, unlike the first 6 months, this is the first time that I can remember as an investor where we don't have really good clarity about what the Fed's going to do. They say they're going to raise rates by another 50 basis points, and that's what the dot plot says. But we're not sure, because inflation is coming down sharply. When you get to June, you're going to have year-over-year CPI down at about 3%. GDP, right now, it's estimated to be 1.5 to 2. So as we get into the July meeting, with inflation coming down, GDP coming down, and still systemic risk out there. You still have banks struggling because you've got money market rates of 5 to 5.5%, and they're paying 1.5 to 2% on deposits. So you still have the risk that the more they raise, the more that deposits could go out the bank's deposit window. And so as a result of that, you got a lot of systemic risk out there. So I believe as we get into the rest of the year, you'll have the economy choppy. And if the economy's choppy, a fund that hedges its longs with alpha shorts, and we're targeting, you gotta be careful, we're targeting S&P returns with half the risk because we are shorting. We're looking about 100% long today. We're about 40% short, so our net's about 60. That net number can go between 40 and 60% based on our view about the economy and the markets. We're pretty bullish right now about the market, so we feel pretty good about it. It's FFLS is the ticker on the New York Stock Exchange.
All right, thanks, Gary. We got to jump. Appreciate it. Gary Black, Managing Partner of the Future Fund.